I'm Alan Blackwell from New Mortgages. As does what it says on the tin, we do mortgages, we arrange mortgages for people. So what I thought I'd do is, instead of just giving you the normal spiel, I thought we'd run through a little story with two couples on their little journey through the mortgage market. So we're going to start off on Monday morning, and our first couple come in, David and Victoria. And David and Victoria come in and they want to buy their first property. Slight problem is, though, that they haven't got a deposit. Lots of income, but they haven't got a deposit. But they've seen the sign in the shop window that says 100% loan to value mortgages. And yes, we can do that. So what it is, first of all, we ask David and Victoria, your parents, do they own properties? And they do. And have they got a big mortgage? No, they've almost paid their mortgage off. Do you get on well with your parents? Yes. So in that instance, what we can actually do is we can do what's called a collateral charge on the parent's home, and the clients can borrow 100% of the purchase price. So, yeah, very useful. And with that, of course, they get to buy their first property. Our next couple come in, Gavin and Stacey. And Gavin and Stacey, they've got a small 5% deposit, but they're not sure if they can actually afford the mortgage. And they've heard of things called guarantor mortgages, which we say, yes, yeah, we could do that. We could use your parents' income to help you. But it actually turns out that they can actually afford the mortgage themselves. So, but when they look at the figures and they actually see how much the monthly payments are, they say, this sounds a bit steep. Is there any way we can get that down? We say, well, actually, we can. What we could do is we could get you 75% loan to value rates, mortgage rates, which are a lot cheaper than 95% loan to value, by taking out a 20% shared equity loan with a company called Propertunity. So that way you'll have an interest only on 20%, and you'll have 75% loan to value rates. So they got their income, their outgoings down. So everybody's happy, and our first two couples have got their mortgage. Year down the line, David and Victoria come back, and now they want to upgrade their kitchen and their bathroom. But the problem is they're in a 5-year fixed rate, and there's an big early redemption charge if they actually remortgage out. So what we do is we arrange a secured loan for them, because by arranging a secured loan, they don't have to pay the early redemption charge. So they're nice and happy now, and they've got a flash kitchen and a flash bathroom. Everybody's happy. Anyway, we move on down the line. 5 years comes up. Both couples are coming up the end of their fixed rate, and they both want to move. Well, David and Victoria turn up first. Anyway, their circumstances have changed because they've both gone self-employed. David's decided to become a footballer, and Victoria's decided to become a singer. But they've only got 1 year's accounts, and they're a bit worried about this because they've heard you have to have 3 years' accounts. But we soon put their mind at rest because we've got lenders that will actually lend on 1 year's books. So straight away, we get them a mortgage, and they're happy. They move into their new pad. Anyway, Gavin and Stacey turn up. Gavin and Stacey's situation's changed as well. They formed a successful limited company trading 3 years ago, got 3 years' books, but they don't take out very much income. They're a bit concerned because they only take out 12,000 salary and 18,000 dividends. That's 30,000. So they've got 60,000 income to use for affordability. So we ask them, how much money does the company make? Turns out the company makes £210,000 a year. And they got a third partner in there, so there's a third share each. That's £70,000 each. Well, we've actually got lenders that will allow you to use all of that £70,000 profit. So they've got two lots of 70, that's 140,000, plus their two salaries of 12,000, that's 164,000, that they can use now, as opposed to borrowing using 60,000 income. Pretty clever stuff. So all of a sudden, this big pad they're dreaming of is now a reality. Anyway, we move on down the line a little bit, and David and Victoria come back because now they want to become property magnates and they want to start buying property. So we say, well, we could do that. So we can remortgage and take a loan out on you, increase the size of your property, take some equity out, and then that's your deposit to purchase your buy-to-let. So, but what's really important here is they're both now become higher rate taxpayers. So how are they going to own their buy-to-let? Are they going to buy it in their name, or are they going to buy it in a company name? Anyway, we get their accountant in to sort that out. So that's sorted, and now they're on the property market. They're property magnates. Anyway, Gavin and Stacey turn up, and it turns out their business is going big time now, and they've got a big office building, but next to them is a plot of land. And what they'd really like to do is buy this plot of land and build their own offices. But they're a bit worried about could they afford it, how much money would they have to come up with. So we have a look at the accounts and we say to them, well actually, you've got enough money in there, we can put a 40% deposit down, purchase the land, we'll fund the rest of it, and we'll fund 100% of your development costs. So you can build yourself an office building, which you then can move into, and then we can then refinance that out on a long-term commercial mortgage. You don't have to pay any rent anymore. You can put that company into a separate SPV, limited company, so you can pay rent to yourself, and that keeps the property secure and out of harm's way in case the trading company ever has any problems. So next thing that happens is David and Victoria are back again, and it turns out their granny and granddad are a bit hard up, and they haven't got much money. And they'd really like to have some more money so they can treat themselves, do the house up, treat the grandkids and things. Well, obviously not treat David and Victoria. And so we say, well, actually, we could help them there. We could do what's called an equity release lifetime mortgage. It's a great mortgage where you borrow the money, only what you need, and you can make payments up to 10% a year if you want to, but you're not obliged to make any payments. And they say, well, that's perfect, because they don't want to make any payments. So on that short little journey, we've helped all these people out with their little quirks, like 1 year's accounts, people who don't take very much money out of their business, people who've got problems with secured loans, for example, used so they don't have to pay early redemption charges. I think it kind of gives you a feel that there's a lot you can do. The other thing, of course, is if people want short-term finance to ever buy anything, we've got what's called bridging finance, which is really useful in lots of circumstances. When your house chain is maybe going to break down, and you can suddenly borrow money on your equity, buy your purchase, and then obviously complete with your mortgage later. So it's very interesting. But it's all very well borrowing all this money, okay? That's great. But what about protecting your lifestyle? Because I wonder what that was. Protecting your lifestyle, because we get this, and you're improving, you're getting a bigger house, you're getting a better lifestyle, you've got things, but how do you protect it? So on this next sheet we've got here, I'm just going to run you through a little thing about lifestyle. Now everybody in the world basically lives one of 4 lifestyles, okay? That's every free person in the world. Luxury, comfortable, hand to mouth, or basically state benefits and charity. Now I'd suggest most of us we're in the comfortable bracket. Comfortable means we can afford to pay our bills, we can have the odd holiday, to upgrade our car, we can treat the kids, we can live like that, so we're in the comfortable bracket. But what keeps us in that comfortable bracket is basically money, isn't it? It's money, and that money usually comes from income, okay? So if you were to lose that income, what would happen to your lifestyle? Pretty quickly you'd drop down, wouldn't you? You wouldn't be comfortable anymore. You'd be like maybe hand to mouth, or you'd be looking at state benefits, which is a pretty rough way to look at things, isn't it? But the whole point is you can protect your lifestyle, and you can protect it by taking out that boring old thing called insurance. But lifestyle is what you're actually doing. You're actually protecting your lifestyle. Don't think of it as that boring thing called insurance. The 2 reasons you do usually lose your income is through death, or more commonly, sickness or accidents. Well, sickness and accident can be covered off by income protection policies, and death, the income can be replaced by life insurance policies. You can have life insurance lump sum policies to pay off your mortgages and the big things, and you can have what's called family income benefit policies, which will pay you out a lump sum, say, till your children leave home or become independent. So when you think of insurance, you've got to think it's protecting your lifestyle. Do you want to remain comfortable? Do you want your family to remain comfortable? Or do you want to slip down to hand to mouth and struggling, or worse still, actually having to sign on and go on benefits? And that's about it.